Private equity investing is simply the ownership of private companies. The private equity investor has a very specific value creation thesis that is vetted from deep due diligence. After successful completion of the value creation initiatives over a number of years, the company is then sold for a profit. Most investors are familiar with public markets, but in fact, the private market universe has a much larger investable opportunity set. In the US, there are more than 250,000 private companies with at least 50 employees, which compares to only 4,000 public companies. The private equity asset class is one of the largest in the world. There are two main reasons why investors allocate a portion of their portfolio to private equity. The first is a very attractive return potential, and the second is excellent portfolio diversification benefits. On the first point, the private equity asset class has outperformed public assets over the long term. According to Cambridge Associates, the global private equity asset class has outperformed the MSCI World Index by at least 500 basis points over each of the last 10, 15, and 20-year periods. On the second point, there's less volatility in returns and therefore lower correlation to other asset classes. This has been proven during multiple periods of distress, including the GFC. This unique combination of potential for higher absolute returns with lower volatility makes private equity a very compelling investment opportunity. There are three main reasons why private equity is able to outperform public markets. The first reason is that private equity investors generally get access to far more information than their peers in public markets, most of which is highly confidential. For example, we can review all contracts with key customers and suppliers, hire accounting firms for quality of earnings analysis and tax due diligence, hire law firms for legal and benefits due diligence. We also perform background checks on senior management and much more. The second reason is that public companies often suffer from agency problems and misalignment of interests between shareholders, management, and the board of directors. However, in private equity, there is very strong alignment. This results from private owners typically controlling the board of directors and dictating governance. Private equity board members have real skin in the game, which is not the case for many public companies. Also, the management teams of private equity portfolio companies are incentivized on the same exit timeline as the private equity owners. The third reason is that there are many value creation levers that private equity owners and Fiera Comox can use to increase the total value of a company. One lever that stands out in contrast to public companies is our ability to focus on a long-term time horizon, which enables our private companies to make capital investment decisions that may lower earnings in the short term, but increase total value over the long term. Many public companies are managed with a short-term mindset, quarter to quarter, and don't have this luxury. In addition, we work very closely with our management teams and our investment partners to execute tuck-in acquisitions to achieve cost and revenue synergies or gain access to new markets. We also bring our capital markets expertise and relationships to bear to ensure our companies have the most efficient and lowest cost debt in our capital structures. The percentage of your portfolio that you should allocate to private equity really depends on your unique investment horizon and needs. Over the past 2 decades, I have worked at both CPPIB and the Ontario Teachers' Pension Plan. These are two of the most sophisticated private equity investors in the world, and as a point of reference, they both have approximately 1/4 of their total portfolios allocated to private equity, and it has been a key driver of their outperformance. Also, in the US, many of the highly regarded Ivy League university endowments have more than 40% allocated to private equity. However, as each investor's situation is unique, your allocation to private equity should be determined based on your specific investment objectives.